You found my channel. Welcome. I'm Uncle Dan, and I've been helping my family and friends for decades figure out solutions to their problems when it comes to investments. Today, we're going to talk about hedging that portfolio with puts on the SPY. Very important with this market heading down. So listen up and take advantage of this insightful session on the very basics of understanding put options. Good luck. This put option is nothing more than a contract between a buyer and a seller. There's two parties involved. Someone's going to buy the contract and someone's going to sell it. And these people are typically anonymous. So Friday, June 12th in the morning at 9:36 a.m., I went in and bought a put. I'm using the ThinkorSwim platform, and it costs 60 cents a contract to buy options on that platform. So what I did is I bought a put, which gives me the right to sell 100 shares at a strike price. And in this case, the strike price was 303. And then if you have a contract with someone, you obviously got to have a timeline or a deadline or a date when the contract exists, when it expires. And in this case, the expiry is 1 day. And we did this contract in what's called the SPY ETF. So it's a basket of stocks. So we did it at 9:36 in the morning at 45 cents. Now, the put contract, when you buy one of these, it's because you think the market's going to drop. And so you really have two choices. One is you can buy a put, and that gives you the right to sell 100 shares at the strike price at 303, but it's only going to be valid for a day, and I paid $45 for it. The alternative is to sell 100 shares of the SPY, which is going to cost me $30,800 with unlimited risk to the upside. Now, on the opening, the SPY was trading at 308. So, of course, if you sold the SPY at 308 because you knew it was going to go all the way down to 298, you could make $1,000. But you have unlimited risk to the upside if something goes wrong. And so you got to decide whether you're willing to accept unlimited risk. With an option, you only can lose what you paid for the option that you bought. Right? So we don't necessarily want to go in and just sell 100 shares because we need $30,800 to do it, but we also have unlimited risk. So you're better off managing your risk at order entry and just paying $45 for an option, because the most you can lose is that $45. Now the challenge is, when do you sell your put for a profit? And where would you go? Well, luckily, there are exchanges you can go to, and you can buy and sell them the same way you buy and sell a stock. So there's market makers, and there's also investors who are buying and selling these. So there's plenty of liquidity when you want to try to sell your option. Now, here's a live quote in the afternoon. It was showing you where the options were trading. So there's plenty of liquidity. You can see the SPY trading above at 300.20. And then there's the put trading at 322, had not yet reached our target price. We have a limit order in the market waiting to be filled if the SPY put spikes up. If you don't know when you want to sell, here's the challenge for you. You have an expiry date, and if you don't sell, you're going to lose the money you paid for the option, and you won't be able to lock in your profits. So here's a graph of the option price. It actually shot up to 464. We had a limit order at 450. We got filled, and immediately it dropped down to $1.50, and it expired worthless. So you have to move quick on that. So why did we buy a put? Just to summarize, we bought a put because we thought the market would go down. And so we bought a put on the SPY when the SPY was trading at 308. It dropped down to 298.60 on the day. So big move down. We got lucky. Remember, the markets are random. We just get lucky from time to time. So the stock dropped to 298.60, and what did we do? We had an order waiting to be filled at 10 times profit. And baby, we nailed it. So our order was filled at 450. It went to a maximum of 460, and we locked in the money. So boom, that's how it's done. Now remember, the markets are still random.